Picture this. The Federal Reserve finally signals it's ready to cut interest rates. The markets don't just react, they roar. Stocks surge, portfolios shift, and new opportunities emerge for those who position themselves early. Right now, the anticipation for a pivot is building, and it's not just a headline, it's a potential game changer for your investments. In this video, we're diving into 10 US stocks that could take off when the Fed lowers rates. These are growth names that thrive when borrowing costs drop, value plays ready for a comeback, and a few hidden gems poised to shine. Whether you're a seasoned investor or just starting out, this list is designed to help you get ahead of the curve. Welcome to Bucks and Beyond, where we break down money, markets, and smart long-term investing decisions. My goal is to hit 1,000 subscribers by the year end, so if you find value here, hit that subscribe button and let's grow this community together. Let's dive into the countdown. Buckle up. It's going to be a packed ride. Kicking things off is Bank of America, a name that might surprise you. Many assume rate cuts are bad for banks because they squeeze net interest margins, the difference between what banks earn on loans and pay on deposits. But Bank of America is more than just a traditional lender. Its massive wealth management division thrives when markets rally, as lower rates often spark investor optimism. Plus, when borrowing costs drop, loan demand tends to pick up. Think small businesses expanding or consumers taking on car loans to upgrade their rides. A soft economic landing, which many expect alongside rate cuts, would boost consumer confidence and credit growth. Both play to Bank of America's strength as a retail banking giant. Valuation-wise, Bank of America is a steal. It trades at under 13 times forward earnings, offering value in a pricey market. Plus, its 2% dividend yield provides a steady income while you wait for the upside. Bank of America is a balanced pick for those looking to capitalize on Fed pivot without excessive risk. At number 9, we have Home Depot, a household name deeply tied to interest rates. When rates spiked, mortgage costs soared, and homebuyers hit pause. That slowdown hurt renovation activity as few people took on big projects. But when the Fed cuts rates, the housing market could heat up again. Lower rates mean cheaper mortgages, which often lead to more refinancing and home improvement projects. Think about how many people revamped their homes during the pandemic. That demand could reignite. Home Depot is the go-to retailer for DIYers and contractors alike, stocking everything from lumber to lighting. Beyond the housing angle, Home Depot's fundamentals are rock solid. Consistent cash flow, disciplined store expansion, and a dividend that's grown for 15 consecutive years. This isn't just a pandemic-era winner. Home Depot's ability to navigate economic cycles make it a reliable bet for a rate cut rally. If you're bullish on consumer confidence rebounding, Home Depot deserves a spot on your watch list. Coming in at number 8 is Visa, a name that might not scream rate-sensitive at first glance. But here's the deal. When interest rates fall, consumer sentiment improves, wallets open, and spending picks up. Visa, as a global payment giant, takes a small cut of every transaction, making it a pure play on economic activity. Unlike banks, Visa carries no credit risk. It doesn't lend money, it just processes payments. This makes it a low-risk way to bet on a spending rebound. With operating margins above 60%, Visa's business is insanely scalable. Add in a robust share buyback program and a dividend that has grown steadily, and you've got a stock that's both defensive and growth-oriented. Think of Visa as a toll booth on global economy, collecting fees every time you swipe, tap, or click to pay. When the economy shifts into high gear, Visa's revenue accelerates without the baggage of loan defaults. It's a toll booth on global economy, and rate cuts could send more traffic its way. At number 7, we have Amazon, a mega-cap juggernaut that thrives in low-rate environment. Why? Low rates make growth stocks more attractive, as cheaper capital fuels investor appetite for big names like Amazon. But it's not just about valuation, it's about Amazon's business model. When rates drop, consumers have more disposable income, boosting Amazon's e-commerce sales. Meanwhile, AWS, Amazon Web Services, the cloud computing arm, continues to drive massive profits as businesses ramp up digital transformation. And don't sleep on Amazon's advertising segment, which is growing rapidly as brands spend more money in a healthy economy. Amazon's multiple revenue streams, retail, cloud, advertising, make it a diversified bet on a rate cut rally. If you're looking for a stock with scale, innovation, and resilience, Amazon is tough to beat. Now let's talk about income with Realty Income, one of the most iconic REITs in the market. REITs have been hammered by rising rates as higher yields on bonds make their dividends less attractive. But when rates fall, REITs often stage a comeback, and Realty Income is perfectly positioned. This REIT owns high-quality net lease properties leased to stable tenants like Walgreens, Dollar General, and 7-Eleven. Its 5.5% dividend yield paid monthly is a dream for income investors. When rates drop, Realty Income's yield becomes more competitive, and its stock price could surge as investors pile back into REITs. With a track record of 31 years of dividend increases, Realty Income is a rare blend of safety and growth. If you're hunting for a yield with upside potential, this one's a must-watch. At number 5, we have Alphabet, the parent company of Google. This tech titan is a no-brainer for a rate cut environment. As the world's leading advertising platform, Alphabet benefits when businesses loosen their budgets, which often happens when borrowing costs drop. But Alphabet is more than just ads. It owns YouTube, a cash cow with massive growth potential, Google Cloud, which is gaining traction in the cloud wars, and a suite of AI investment that position it at the forefront of innovation. With over $95 billion in cash on its balance sheet, Alphabet has the firepower to keep investing while returning capital to shareholders. Trading as a reasonable valuation for its earning power, Google is a growth stock with a defensive moat. When rates fall, expect Alphabet to ride the wave of renewed investor optimism. Number 4 is CrowdStrike, a high-growth leader in cybersecurity. In high-rate environment, investors often shy away from pricey growth stocks like CrowdStrike. But when rates drop, risk appetite returns, and names like CrowdStrike can soar. CrowdStrike's cloud-based platform protects businesses from cyber threats, a need that is only growing as digital transformation accelerates. With strong revenue growth, improving margins, and a massive addressable market, this stock is built for the long haul. It's not cheap, but that's the point. Buying quality growth before macro environment shifts in its favor can pay off big. Cybersecurity is a non-negotiable expense for businesses, and CrowdStrike is the top dog in the space. Rate cuts could unlock its next leg up. At number 3, we have Adobe, a software giant with serious pricing power. When rates fall, software companies like Adobe often see their valuation expand, as investors are willing to pay a premium for reliable growth. Adobe's Creative Cloud suite, think Photoshop, Illustrator, and Premiere, generates steady recurring revenue, while its newer AI-driven tools are opening up fresh growth avenues. As businesses ramp up spending in low-rate environment, Adobe's product become even more essential. This is a quiet compounder with a history of delivering for shareholders. If you want exposure to software and AI with the rate cut tailwind, Adobe is the name to consider. Number 2 is Meta Platforms, the force behind Facebook, Instagram, and WhatsApp. Meta has already staged a comeback, but it's still undervalued compared to other tech giants. Lower rates could supercharge its growth in digital advertising, AI, and even its metaverse bets. After aggressive cost-cutting, Meta's profitability is stronger than ever. Its ad business is rebounding, and the recent introduction of dividend ads appeal for balanced portfolios. When the Fed pivots, expect Meta to attract both growth and value investors. What's your favorite Meta platform? Let's hear it in the comments. And at number 1, we have Apple, the ultimate quality growth hybrid. You might wonder why Apple tops the list, but it's simple. Apple thrives in a low-rate environment for 3 key reasons. First, cheaper financing makes iPhones and other Apple products more affordable through installment plans. Second, Apple's massive stock buyback program becomes even more effective when borrowing costs drop. Third, as capital flows back into megacaps, Apple's valuation tends to expand. With a service business growing rapidly, think Apple Music and iCloud, and a fortress balance sheet, Apple is a stability anchor that performs in any market. It's not a 10x stock, but it's a reliable winner for investors who want to sleep well at night. The Fed's rate cut might still be on the horizon, but markets don't wait for official announcements. They move on anticipation. These 10 stocks spanning banks, retail, tech, and REITs are positioned to benefit from easier monetary policy. The key isn't timing the pivot perfectly, it's preparing your portfolio now for the opportunities ahead. Which stock from this list are you eyeing or already own? Drop it in the comments below. If you found this video helpful, give it a like and hit that subscribe button to help me reach my goal of 1,000 subscribers by the year end. For more investing ideas, check out my channel for other videos which might interest you. Thanks for watching, I'll see you in the next video.